a lot of them seem motivated by COVID-19, and a number of them were published at the National Institute of Health site. So I don't know why exactly. There must have been some funding that was available,
Yes. Yeah.
right?
Yeah. I found a lot of papers on, power laws in the spread of COVID,
Yeah.
for example.
So
Yeah.
the impact of COVID-19 on the dynamics of cryptocurrency markets, stability and irregularity of cryptocurrency markets during COVID-19. It's not too relevant for our purposes about that, but here's one. This is the sixth paper, Lewin Chin. It was done only a couple of years ago. Highlighted APN, which is approximate entropy, ability to signal turmoil and transitions linking to macroeconomic uncertainty. So the plot here, the figure is from that paper, and it shows the order of M2 and the order of M3, and you can see that the orange curve is always below the blue curve. As you crank the order up, it does go down, but they're both significant, and they both have some fair amount of variability, with the M equals 2 running between about 0.5 and 0.8, which is pretty noisy or irregular, right? And then the M equals 3 running between about 0.2 up to about 0.6. So it's showing irregularity, and you look where COVID was, you're kind of in the middle of the plot. I don't know. And yeah, that's the one, Lewin Chin, sustainable finance, Bitcoin, and fractal entropy analysis. So they used 8 years of daily log returns, and that's just the percentage change, but in log terms. There was one other paper. The particular results weren't that interesting, but in general, they said that they showed that Bitcoin combines high standard deviation and low approximate entropy. So that's interesting, right? Those are two things that are sort of in conflict with each other, but that's what we know Bitcoin to be. It has high overall volatility, but low approximate entropy. And as we'll see, particularly in the power law core, relative to gold and the S&P 500. And just a reminder of the Hurst exponent and comparison. This is what we had found for the Hurst exponent. It stays very high. It's a signal that shows us there's a lot of order and persistence of the alpha, of the outperformance of Bitcoin. That hasn't gone away.
So for maybe, for the people that are not super familiar with some of the basics, entropy, right, even at a popular level, is associated with some level of disorder, right? Something that has a high entropy means disorderly behavior, right? So
Let's clarify. Let's clarify that. It also is associated with high information. In other words, if you have a very simple system at a uniform temperature, and what the component molecules are, they're, N2 and O2, right? Like in our atmosphere, and the temperature and the density or the pressure, you can characterize the air in the room with just a few values, right? And with the power law, we characterize the long-term behavior with only two parameters, a scaling factor and a power law index.
Right.
So that's low information. That's low entropy. We don't, there's not a lot of surprising information there. Entropy is high when you get surprises. So bubbles growing and collapsing, those are surprises. And those require much more detailed analysis to understand, more parameters. So for example, the log periodic power law has 7 parameters, and you need something with a lot of parameters to characterize the growth of bubbles and their collapse.
Yeah, this is why I did an interview a few days ago, and somebody said, "Oh, there is a critic of yours." They say, "It's some guy called Morris."
Yeah.
I don't know. I will not go in the personal details, but to say, "Oh, you may overfit the power law." When you have something like one parameter, I always say actually the power law has one parameter, because actually the scaling, it's it depends. You can have a scaling, have a bottom, for the support. You can have it a little bit. It's really one parameter with slope,
Right.
right? That is really essential. So it's basically impossible to overfit something that has one parameter. It's impossible.
Right.
There is nothing to overfit there. So it's somebody that doesn't understand the math. You can overfit something that has a lot of parameters. But yes.
Yeah. Whether you do it in gold and dollars, euro, or yen, the scaling factor is different from those, right?
Yeah.
But the parameter is essentially the same against
Yes.
all those. So that's the one key parameter. So relative to this Hurst exponent method, a low approximate entropy aligns with a high value of H, and we have very high values of H. It's about also more local in time frame, local irregularity. How hard can you predict? How hard is it to predict the next value? Whereas Hurst is more about long-term global memory, long-term trend persistence. So they may agree, white noise, for example, would have high approximate entropy and H would be 0.5. When H is low, you have mean reversion, and that's what Standard & Poor's, SPY and stock market does. Okay, here are the results for the whole suite of data, 15 years of weekly data. And I did, 3 analyses, one for log price, one for the log return, and then one for the residuals after removing the power law.
Mm-hmm.
And we get a very low number of 0.07 using the log price. So that says, not surprisingly, strong trend, highly predictable. We get a high value when you use the log return because it's local noise.
Yeah.
Highly irregular, volatility driven.
I want to say, when you take returns, you're taking the differences, right? And
Yes.
so it's almost like a way of detrending in a way. And so in that case, you will emphasize the noise more than the trend.
Correct. These are just the week-to-week percentage returns, basically. With short vectors, so they're just from one week to the next.
Right. Now, if you're looking at a long period of time for the returns, even that has a trend. But yeah.
So that's the next one, which is the residuals, where we take the power law, and then you see it drops dramatically. It falls from 1.4 to 0.5. So that says we've got moderately structured noise, and we may even be seeing cycles. And at least you're seeing, regimes where it goes from one regime to another. So low app-in for trend, high for returns, intermediate for residuals is a signature of nonlinear financial system with long-term structural growth, chaotic volatility in the short term, and an intermediate structure in the fluctuations, which might be due to cycles or might be due to regime changes. Certainly, we have seen these rather sharp changes between the power law core and the bubble regimes. Okay, so then I broke out by core and bubble and say, let's just do on each of those. And then the core, again, it's 0.07, not surprising. And the bubble is also quite a low number. It's 0.13. Of course, it's higher, but it's, so it's got some complexity. So, of course, Bitcoin behaves in a more structured and deterministic way when it's priced at or below its fair value. And if you go to the next higher order, M of 3, you get about the same results for log. This is all for log prices. And then I went to the higher order for those 3 series with M equals 3, and the numbers should be smaller, and they are. So the log 10 prices was still very low, similar. Log 10 returns dropped roughly in half to 0.74, and the power law residuals came down a lot to 0.47. This is formally called the embedding dimension of M equals 3. So it means a bunch of vectors of length 3, comparing them one to the next, seeing how far apart they are. Bitcoin's long-term price path is almost deterministic, while the weekly returns and trend residuals contain moderate structure, suggesting nonlinear dynamics, not just randomness. Okay, now let's look at how this develops with time, and it gets quite interesting. So here, the blue color is the price, the approximate entry history for the price, and I used a 2-year filter, a 100-week rolling approximate entry for each of these series. The orange is the log 10 return, and the green is the residuals, power law detrended. People who look at the also I have the price there is the soft gray line. So the first kind of analysis by chat was spikes have unsustainable price action. Entropy is not just volatility, it reflects a pattern of unpredictability. A nonlinear regime switching system between low entropy trend following and high entropy chaos. So that's the kind of very high level. But the next thing, if you're observant, is you might notice that some things are lining up with price peaks. And that will become clearer in the next chart. And this is for the case of the shortest vectors, m equals 2, 2-year rolling average, and R is 0.2 means 20% standard deviation. That's what you're counting. And that's typical value that's used in these analyses. Now let's check when the peaks and the minimum happen, and then the price peak. So if we look at 2013, 2014, the red dash line is the price peak for that 2013 bubble.
Mm-hmm.
And you can see that for each of the price minimum or the maximum for the log 10 return entropy and the maximum for the residuals entropy, that they're lining up pretty nicely.
So two things. One, the value is low, right?
Log, they're all logs.
Yeah. And but at the peak, the value tends to be small, right?
These are the approximate entropy for all of these, and for log 10 price, it's small.
Yeah. What is the interpretation of that? Why have a peak? We will have a.
Well, remember, these are 2-year rolling.
Right. Okay. So it's basically looking back 2 years, right?
Yeah.
Probably because we actually went up, right? Went up over that period in a pretty steady way, right?
Right.
Is that a possible interpretation of what is going on? Why?
I think it's seeing. This is the 2 years prior, right? So it's the 104-week rolling for the 2 years prior.
There was momentum in the price. There was a directionality because there was momentum, right?
It's seeing the momentum of the prior 2 years price.
Right. Yeah.
Okay, so they line up well for the end of 2013 bubble. They line up pretty well for the end of 2017 bubble. They line up well for the 2021, which was a double bubble. And even for the little kind of small bubble we had with a peak at the end of 2024, they line up.
Yeah.
So the way you want to look at this is look at the blue and the orange in particular. The green's pretty noisy. It's kind of a lot of structure in there, a little harder to pick out. But you find that in each case, the orange, which is the log 10 return approximate entropy, is leading price. That peak occurs first. And the log 10 price approximate entropy is lagging the price peak and confirming it, if you will. And this shows how much I cleaned it up by removing the green line and also showing the peaks a little more clearly with these dashed lines for the blue and the orange, for the price and the return. And you can see how close those are to the red dashed lines, which are the price peaks. In general terms, they're pretty close.
Mm-hmm.
The orange lead is longer. And so if we compare the approximate entropy minimum in the price and the log price, it lags by about up to 12 weeks.
So the fact that maybe the lowest points, right, that are associated with the peak, this is for the blue line. It seems there is a general trend, right, that we're actually going to higher and higher entropies. How will you interpret that?
Oh, yeah. I don't know. I mean, I noticed it, but I don't have an interpretation yet. It
Could
may,
it be that the cycles are less
it
pronounced?
may be related to the weakening of the cycles,
Yeah.
strangely enough, but I'm not sure that that makes sense.
Okay. Yeah.
And then the log 10 return lead is around 40 weeks in most cases. Now, if you look at the most recent one, our max for the orange line, the log 10 return was in April.
Hmm.
So 40 weeks after that was a peak at the beginning of December, which was our last price peak. Hopefully we'll break through that, and in fact
Yeah.
we did set another price
Yeah,
high
this cycle is so
recently.
anomalous. This is another
Yeah.
piece of evidence that this cycle doesn't behave like the others.
So was that the bubble is a question, or is this the first of a double bubble? That's an open
Yeah,
question.
exactly.
And then the blue minimum in this case was in March, beginning of March this year, which interestingly was around the time of the maximum tariff uncertainty.
Mm-hmm.
Now, this is the higher order, M equals 3. And again, you see things are lining up similarly. I've used these kind of ovals to mark where there's the overlap, but qualitatively similar, but the values are lower. It highlights deeper, more structured behavior. You now see distinct low entropy pockets for trend-driven runs and market corrections. So here's one point, is that the trend-driven run will give you low entropy, right? So that's part of what we're seeing there. And here are the timings.
What M3 means that you're looking at 3 data points instead of
Yeah, it's actually looking at 3 and 4. So it's taking vectors of 3, computing that, 5 parameter, which is a sum of the log of the probabilities of being within a fraction of the standard deviation. And then it's doing it the next higher, which is M of 4, and it's taking the difference. That's the formula. So M of 3 is the base, and then M plus 1 is the higher embedding, and it compares those two to calculate the entropy. And then this shows the timings of where the peaks with these dashed lines again. And qualitatively similar, a little bit different in details. But the price normally the approximate entropy of the log 10 price normally lags the price peak by up to 16 weeks, but in one case, we show it preceding, which is actually the latest one. And then the orange peak, the log 10 returns, those precede by roughly 20 weeks.
So it almost reminds me the relationship between the blue and the orange, like sine and cosine, right? Like
Yes,
if you have a velocity, a position and velocity, right? We are going to be in a harmonic oscillator. We are going to be out of phase by 90 degrees, right? And
correct,
this seems to be the same here, right?
correct.
There is a peak for the orange when there is a low for the blue. Because the return is almost like the velocity of the price, right?
Right. So I guess the takeaway is that there's some predictability here,
Mm-hmm.
and that it works at M equal 2, it works at M equals 3. I'm not sure if one is better than the other, and they're roughly similar.
Have you tried to make a very long moving average, like at 4 years, for example, or whatever, and see how that looks like? To
Extremely long vector.
no moving average, to maybe to kind of de-emphasize the cycle. I'm curious to see.
Yeah, I looked at the 4 year and it was a mess.
It was a mess. Okay,
Yeah.
probably because it's still a bunch of small little vectors, right? So that
Mm.
don't have. But what will it work if we make them big, like like a bunch of vectors? I'm trying to understand how this quantity grows without the bubbles, like if you don't have the bubbles,
Right.
or maybe you can smooth first, like maybe you can take an average of a price, right, a moving average of price over 4 years, and then do
Mm.
these calculations over that quantity.
Mm. Yeah.
I want to see if entropy, the general entropy, this quantity of entropy grows with time over the
Mm. Mm.
smoothed behavior.
Mm.
I will play with it to myself. It's
Yeah.
very interesting. Yeah.
It's an interesting technique. Okay, so a reminder that the differentiation between the core and the bubbles is dropping. The core has consistently had standard deviations. These are average with a rolling 4 year filter, but around 20%, whereas the bubble standard deviation has dropped from 100% to below 40%. So they're converging. And then it's done that with roughly a reciprocal relationship. So, it opens the question as to whether the mini bubble that we saw um, at the end of last year was it. Now, a few slides on Bitcoin treasury companies. I saw this from, what's the name of it? Microstrategist.com. This idea about how does the yield fall off. So first, there are now over 100 companies that have adopted Bitcoin treasury strategies. Um, Michael Saylor's way off the chart. So in this fit, I did a parallel fit to the BTC holdings of the top 99 companies, except for strategy, because it is really way off the chart. And so the question is, do you have something? This is a rank. So it's, the size of the holdings relative to the rank. And you're asking if it adheres to something like a Zipf's law, which would have a power law of -1. And it does for the first 15 or 16, for the top of the list, if you exclude master.
Mhm.
And then all the rest are way behind, but they've also entered the game fairly recently. So it kind
Right.
of shows what they need to try to do. Yeah, what happens is that as networks mature, they move towards Zipf's law.
Yeah.
I'm reading an interesting paper now about cities and how they do that. And the network has to mature. Things have to be able to kind of move around. And since they're very new, it's not a mature network. So,
Yeah, we don't behave yet as real networks. Yeah.
so we'll see how they develop over time.
Very interesting.
But now on to the yield. I mean, the one on the left just shows the stacking race. This is from MicroStrategist. And, we see the top ones being Strategy and Mara, 21, which just got started, Simler and Congo. And, the one that's really moving now is the Japanese one, Metaplanet, the
Mhm.
orange one.
Very steep.
Yeah. So, but then they said, well, it looks like the Bitcoin yield is falling as a power law. So they took essentially these curves and then converted them into yield per day and then normalized them to whenever the particular company started their Bitcoin treasury strategy. So it's days from the start of Bitcoin strategy for that particular company, you know, And of course, the long purple one is strategy, and it's the only one that exceeds 1,000 days or 3 years. It's 4 years or so now, almost five. And so, they've got more data early on for the high yields and less later on because there just aren't that many companies that are even over 1 year, right? But they took all this, what's on this graph, and then they tried to compress it all into a single power law by averaging the yield across the data set that they had. And they said, oh, it's falling as x to the minus 0.95. That is the days from the start of the Bitcoin strategy for each particular company timed to the roughly, -1, roughly the reciprocal of the age. So they said it's falling like this. And just to calibrate things for you, if you're at 0.1% per day, that's 44% per annum Bitcoin yield. And if you're at 0.01%, that's 3.7% per annum. So, we care a lot about the difference between those two, right? Staying above at 0.1 is really nice, and dropping to 0.01 is okay, but less interesting. So I said, well, gosh, what happens if you then take this equation and then turn it into what kind of stack would you accumulate? If you follow that dotted line, how would your stack grow with time? And I found that if you started with 3 coins at 10 days, you could get to 6 at 100 days, you could get to 10 at 1,000 days, but it gets really hard. It takes you 30 years to get to 14, and it takes you 300 years to get to 19. So this shows, the Red Queen race that's going on, how they just really have to run very fast to try to get ahead of each other and get Bitcoin from the market at all. And then the next slide says, well, this does not apply to strategy yet. This is Bitcoin's annual yield for strategy from the beginning. And it was 200%. It dropped all the way down to a small number, less than 10%, until they figured out how to raise money from the market, particularly with preferred stocks and so forth, so that they wouldn't have dilution. And so actually they've been able to increase the annual ever since then. They had a really strong quarter at the end of last year, with just that one quarter had 77%. If you take the first half, strategy's at 19%. So if somehow they're able to maintain that and not to have decline, unlike the previous slide that says it falls inversely with time, then they could get to 2.1 million in 3.6 years, which Saylor would like to do. So my takeaway is that the lead horse gets the most capital, because the reason they're able to do that is because the market is willing to give them capital for their preferred shares of various types. And if they need to do an ATM, the market's with equity, the market's willing to give them capital for that. And the market's not going to give capital to all of these others in anywhere like equal amounts. And so they're more likely to suffer decline. So that's it for my slides.
Fantastic. So you think it's not a good idea to invest in all the other treasury companies?
I think you have to watch them. I think they may be good, 1-year trades, right? I personally own some similar and some Metaplanet. I would stick to the leads, the highest quality ones that look like they're a little bit underpriced and that have the largest stacks and the highest yields, but not so overpriced relative to their yield.
Yeah. Okay. So I'm going to discuss my section of things. All right. So let me go to the right slide. So first I will discuss this. And again, whenever we talk about somebody else post or comment, we are not trying to put them down or be polemical. It's just that, it's an opportunity to discuss, because, different people follow different analysts, people say different things. The beauty of having evidence-based approach is that it's not politics, right? It's not opinions. It has to be something is true or is not true. And there are methods, and one can discuss how you go about improving this, one can have a debate, but in the end, has to be, when somebody makes a claim, has to be that there is a way of demonstrating if this claim is true or not, right? So anyway, so I saw this video from Sina. Sina is a professional. He's a PhD in his field. He's, business. He's more focused on business. And it teaches some econometric classes where the fundamental of data analysis of price action is discussed. My problem with that is that the entire idea of doing research is that you use the book as your foundation, and then you go beyond the book, right? The book, what is in the book was research 10, 15, 20, 30 years ago, and then has been verified and made it to the book. Research is by definition something that is not in the book, and so many times you have to be a little bit open-minded, and you have to be creative to do research. So the topic in question in this video, I think several people watch, is that this discussion that it's relevant to many people. Many people are interested in this because it's one of the things that people look at to get some level of comfort or directionality for the price. They want to know what is going to happen next, right? And so is this idea, we already explored it, but so this is kind of revisiting a little bit this topic in particular at the light of these comments from Sina. From what I understood, Sina say things that I have said myself many times about this relationship between global liquidity, in particular this quantity called M2, and the price, right? I started with a generic model of global liquidity versus price. In the beginning, I even resisted that because my approach was I want to look at only Bitcoin, everything internally at Bitcoin. I think Bitcoin determines its own price. You don't need to look at external things. But, under pressure, I started to look at M2 or other measure of global liquidity, and it was useful. The first time I ever made a plot of a price versus global liquidity, I didn't see, of course, I tried everything. I tried if it was an exponential relationship. I tried if it was a power law. And it was, if you took the entire history, this is something that me and Steven also discussed. It doesn't look like a power law. It's more complicated than that. It's so complicated that, in fact, you have to start to use what is called a Taylor expansion, that means a polynomial model, basically where you add more and more terms. And we already discussed this idea of adding more terms. Once you add more terms, you can fit anything. There is this mathematical theorem called Taylor theorem that basically says if you add more and more polynomial, and these polynomials have higher and higher power, right? You start with a constant, when you add x, when you add a square, x cubed, x4, you can approximate absolutely anything. Every twist and turn. The problem that when you do that, it has zero predictive power because you are basically creating a model of a past, and the entire idea of making a model that applies also to the future is to eliminate the noise and the things that are just local and that they're not going to be repeated, and finding the signal if there is some kind of long-term trajectory. So you want to arrive to that. The beauty of a power law that is exactly doing that, is trying to find the signal in the noise. But if you add a more and more term, you're just basically just modeling the noise, and you're losing the signal. So, and you can still do it if it is a compromise. That is a compromise. It's something that maybe will work just for a little while. You will have to adjust it over time. So I made basically a polynomial expansion of a relationship between global liquidity and um, and the price. And I posted, I made an article, wrote an article. Then people started to discuss and this idea that maybe there was a delay, there is some kind of a shift between global liquidity and the price. And for example, this person that actually me, Stephen, Fred actually interviewed, his name is Owl, and he's a kind of old timer in finance and somebody that knows what he's talking about and a respected figure. He wrote several books about uh, micro economics. He also stated that there is this shift, and I started to take it more seriously. I looked into it and actually got convinced that yes, there are two things that I found out. One, if you limit your time frame to 10 years, the relationship between the global liquidity and the price looks like a power law. It's not foundational in the sense that it's not based on something fundamental, because after all, the long-term growth of the global liquidity, it's an exponential, and the long-term trajectory of the coin is a power law. So they cannot be related by a simple relationship, right? It has to be something more complex. But if you look at a short term of it is 10 years, it is still decent amount of time. It's a good approximation to say there is a power law. And it's a crazy power law because the power is 9. That means a small little change in global liquidity creates a huge change in price. So that is one thing. And then, yes, there is a delay, and you can demonstrate that this delay is not, it's basically, it's not something that you make up because you're trying to pattern matching. Like, basically finding Jesus on a tortilla, or looking at the clouds and say, the cloud looks like an elephant, right? That is a risk that you always run in doing any type of data analysis. But I was, whenever I did that complex model, I actually justify, say, look, I think people that say there is a delay, they are basically doing this, they are doing this pattern matching, and it's not real. And then, that is the beauty of actually using math and science, that you can revisit your idea, test more, and then change your mind, because a good analyst should change his mind in front of new evidence, right? And the evidence to me was overwhelming, but there is a delay. Now, some of the things that Sina said in his video, because basically he was dismissing the entire thing. I think he actually didn't go deep. He was just warning people about this matching. And then most of his video was about overfitting, from basically a textbook point of view, without really spending the time in exploring this topic in depth. And some of the things that he say were valid. So I invite everybody to watch his video, because it's a kind of a little lesson about the idea of overfitting. But and it's good advice in general. But if that is the only thing that happens with this relationship between global liquidity and the price, it will be the end of the story. But the story continues, because actually it turns out that there is a relationship, and I have different ways. Like this indicator already shows you. It's one of the things I will show you how I derived. So hold on, I will explain you this, but you can see them visually. So the orange one is actually global liquidity. I'm calculating a quantity that makes it into an oscillator. I will explain this quantity in a moment, but you can see there are obvious correspondences, right? So you can see where the lows are for this quantity, where the top is, and you will not say that these two are not related to each other. And here I'm using a delay. I'm using a delay of 85 days. Same thing here, where you see the difference between the purple and the green line. The purple, the green line is a little bit a smoother version. It's not simply a moving average. It's actually, I do the moving average. I average first price and global liquidity, and then I try to find a relationship between these smoothed versions of global liquidity and price. But the two match pretty well. The other one The purple one is just pure global liquidity. One of the things that Sina was saying that is useful is that part of the variability of the global liquidity is also the exchange value between dollars, because to other so M2 in this case is the money circulation from many different countries, and different countries use different currencies, but to sum them together you need to convert them to one single currency. You can use gold. In theory, you could convert all of them in gold or some other reference, but usually you do it in US dollars. So you basically calculate how much money, how much yen there is, convert it into dollar. And if a exchange rate changes, it creates some of these fluctuations here, right? Plus, the other things he was saying is that some countries report in different times. Some countries report almost weekly, other countries takes months or even a couple of months. Well, that could explain why there is a delay in the first place, or maybe um, you know it's independent of that. It doesn't matter, because in the end we don't care why there is this delay. If once it is established and you calculate what is the optimal delay, that is it. Anyway, so one of the things I did was this, right? So I say, because there are a couple of problems. One is this variability. So one of the things I agree with Sina, and I see done by other analysts, that is so super silly, is to basically attribute to every, in particular when you zoom in, right, with this quantity. I see certain chart where they say, oh, we are having a local bottom right now. That is because of the global liquidity. It's silly. That is pattern matching. No, it's not every single twist and turns in the global liquidity that determine the price. It's more directional. And the other, so this is one problem. And the other problem is scaling. Like, for example, if you try to match certain, like here, for example, you see how well I'm matching this component, of the price. They seem to be basically on top of each other, but the other one diverge, right? If I stretch and squeeze the global liquidity, I can find ways of actually matching almost every little local pattern, but then I would need to use another amount of stretching and squeezing in the other components, right? So there is some scaling issue. That means that the relationship is not one-to-one, it's more directional. So to avoid this problem at all of scaling, I say, let's look at the direction. So I focus on going up or down. So what are you seeing in this graph? I say, imagine I assign 1 to every time global liquidity goes up, and same thing with the price, and -1 when we go down. So it's basically there are only 2 modes, up or down, and I don't care about how much, right? So only going up and down. And then I calculate. First, actually, I smooth with. You can use different windows. One that works well is 100 days. So I smooth both and do a moving average of the price. I do a moving average of global liquidity, and then I calculate this quantity, right? Basically, I transform the price and GL in -1 and 1, -1 and 1. And then I calculate how well they correlate with each other. So, for example, these, and why it looks like a cloud, I added some noise, because if you do these over and over again, they will, all the ones will go on top of each other, so you will get only one dot here, one dot here, one dot here. So I'm spreading it a little bit. It's just a visual way of showing how many times the two agree, right? So and so I to do that, I added some noise. So some data points it's 0.9, some data point is -1. So, but they are all close to each other, basically means 1, right? Is that clear, Stephen? It's
Yes. So I guess the question is, how much of the weight is in the upper right
right. So
in total?
yeah. So this is about 72%. So
Good.
the times when they agree with each other,
Mhm.
that is in particular up. It's interesting that it's actually not symmetric. They agree more when we go up than when we go down. It's 72 here and about 50 C. It can change. It depends on your smoothing window, but the one that I ended up using when we go down, it's about 56%. So it's beating chance. But this one is very strong, 72% of the time. So you can use this as a predictor because remember, in fact, what did they do? So you see why this works, right? It works because you can see if it was just chance, if the two were not correlated at all, every bubble will look kind of the same density, right? But this is clearly just by visual inspection. I like to do certain things when I do my exploratory calculations that are like this, where I get intuition from exploring things, right? If I see some clustering there, it's not something I don't know if many people use something like that. I come up with methods that make sense to me sometimes. I like this one because I can see it immediately. Aha, there is something going on there. There is a signal, right? You will not have this, you will not have this stronger bubble, right? The denser bubble if it was not this increase in correlation between the two for this case. It's very clear, right? You can see it with your naked eye. And then what they did, I calculate basically when they agree when both GL and price are 1-1, right? So both they say GL say, oh, we're going up, and then there is an agreement in price. And because GL is predictive, we can check, right, if that is the case. And so I change the delay from just 10 days all the way to 140 days. And it's kind of a convex curve. This is called the sensitivity curve. So, and it peaks at about 75 days, something like that. And same kind of peak here. This is the other way when you have -1 and -1 when we go down.
So question, how do you build the daily series for M2 for global liquidity? How is that built?
So on TradingView, there are measures of all the different countries and tools.
How do they get the daily resolution? Are they just interpolating between monthly releases? Or?
I don't know. It's possible that the variability, like Sina was explaining, so they keep the last update, but then there will be some daily variability because the exchange rate changes, right? So your conversion to dollars will change, right? But then there will be a big change like 1 month later, right? When there is a new
update
or whatever.
That seems sensible. Okay.
Yeah, it's not perfect, right? It's amazing if you have any predictability at all, in particular because it's 70 days ahead of time. So I don't care anything that can give me a little bit of advantage in knowing where we are going. It's good enough for me, right? If it is not completely junk, and it's not junk because
could you compute the average win to average loss ratio?
Yeah, exactly. So that is also what they did.
Yeah.
So first of all, here is so for example, with this particular smoothing, it's a very strong smoothing. I think I did under 50 days or something like that. Then I did a curve that represents the cumulative sum of these win and losses, right? And you can see again, structurally, the two agree. Now, with some differences, but in general, like for example, here, you see this bump here? That bump is due to the ETFs. The ETFs came along and we create some kind of decoupling between the global liquidity and Bitcoin. But that is what I'm showing here. That is the winning rate. So basically, I'm looking the losing rate will be 1 minus that, right? So we don't have to calculate both. We can calculate the winning rate. For winning rate, I mean when we went up, and then going and calculating the winning rate average over a window. I think I use again 100 day or something like that. And so the red curve is GL, the black curve is Bitcoin. So this is telling us right? When we have a bubble, the winning rate goes up, right? We have more winning. I should put maybe a reference line at zero point 0.5, but we are going above zero point 0.5 during a bubble. We reach a peak. Now this will be the peak, right? Notice usually the peak for GL happens later, and I think the interpretation of this is that when we have a strong, at least in the past, peak in the price, it's mostly FOMO, right? It decouples from macroeconomics. It's all internal, where people get excited, they push the price up, and it doesn't follow necessarily the liquidity. This is, in fact, the definition of a bubble when you don't have the fundamental behind, right? If a price is basically like a hot vapor, right? Hot steam. You push it, push it, push it, and of course it will collapse because there is no enough liquidity to support this push up. Does it make sense? Is a good interpretation of this idea that BTC and GL will decouple at the top. Stephen?
I think maybe the whales get out early.
Yeah, oh, they were, maybe that is another
they're, they're,
interpretation.
they're saying, oh, yeah.
Yeah, that the whale gets up early because they know what is going on. Right?
Because it's not just the GL level, it's the change in GL. So,
yeah, exactly.
yeah.
And this is and here, and this decoupling here again, it's kind of associated with the FOMO. There was a lot of injection of funds and also excitement about the ETF, and so the two decouple. But in general, you can see you cannot say, and this is with this delay of 75. Basically, I use the top here, whatever top value we got here. And by the way, whenever you have data like this, where you have a sensitivity measure that is very, very smooth, and then it has convexity, that means it has a maximum. This is a very good sign. It's one of the things that we do often in data analysis to say, okay, this measure that you're calculating has some signal, because otherwise it will be just all over the place. And in fact, it has a maximum. You can use that maximum as your best, kind of optimal value. It's a kind of an optimization process, right? And so using that optimization value, that ideal delay. Now, it is possible that maybe there is an optimal value for the bottoms, an optimal value for the top, but we are using one that works in general. You cannot say that these two things are not correlated. It's completely obvious that they are correlated. Now, are they correlated at every twist and turns? No, but in general, yes, they are correlated.
That delay is exactly what Michael Howell found. It was 11
Mhm.
weeks. So,
Exactly.
yeah.
So it's another way of confirming this. It's
Yeah.
it's a real thing. It's there. So while you can tell people to be careful about matching things, etc., you also have to be careful not to throw away the baby with the water. Um, the conclusion is, like, if you hear people say, "Oh, look, right now we can explain this bottom because this local bottom because of the global liquidity," that is silly. Don't listen to that. But the general idea that we can use global liquidity as kind of a directional indicator, and it's one of the many things. We want more than one indicator. We want many different things. It's like going to the doctor, and the doctor does X-rays and MRI, etc. We want to look at many different things, and global liquidity is for sure one of the things to look at. And right now, if you're looking at the chart, the graphic I just show, it's not a live chart, but it's the latest update. Right now, we still are going up. Liquidity is still going up. So that is a good sign. It tells us that it is, should be that we can continue to follow this liquidity at least for the next few weeks. So it's a good sign. I don't think it's necessary, but I don't think it's sufficient, right? In mathematics, we say this condition is sufficient, is necessary and sufficient, right? So necessary means is you need to have it for something to be real or true, and sufficient, if you have it, then it is true. In this case, this one is, I will say, it's not necessary maybe, but it's good to have it, right? You need to have you need to kind of have liquidity for a bull run to be sustained. Otherwise, it will collapse. And right now, yes, we have a liquidity. Liquidity is going in the right direction. So that is what we can say about that. We are. So it's 9:30. It's more than 1 hour. I want to discuss this topic of scarcity, but we can maybe do it next time because in the last few days I was having a lot of discussion. I think these were a little bit more positive because I'm improving my communication about this topic of scarcity. I think I'm going to make it the focus of the next episode and focus only on that, and we can discuss it next time. Um, anyway, so maybe let's focus on the questions now. Um, we have a few. All right. Okay, so we have this question here that says new buys will not care about being a whole coiner anymore, thinking it's all about sats. We will see. I don't know where this comes from, but you have something to say about this idea of because there are a lot of people say,
Yeah,
oh, it's important to have a one coin.
I think it's our responsibility to educate people. There's just a lack of education about this, or a lack of awareness, and people just look at the price and say, "I can't afford that," and they don't understand that they can afford, some number of, 1 million sats or whatever the number is. So I think as a community, we just need to educate people more on this. And I wish there were kind of well-established denominations, smaller denominations, because sats is too small. So I like the idea of kilosats and megasats and gigasats personally. But
Hmm. Yeah, and I think it could be detrimental because I know, and the people that are still on the fence, they see 100,000, they still think, there are still people think that that is the only way to get a Bitcoin, that you will have to buy an entire Bitcoin, and they think I don't have $100,000 to spend on these. So yeah, I don't know. I'm not, and at the same time, of course, it's a little bit. It's one of these things that has a lot of inertia. Where okay, now let's always talk about Bitcoin price only in terms of sats, right? This we can always do that. That is an option, right? Maybe like in languages, like like in San Diego, right? You find a lot of places where you have both English and Spanish. So maybe can have both, right? Whenever the price is quoted, we should have Bitcoin and then Sats, right? Maybe both of them. Um, that could be at least a temporary solution, and specify that people can buy fractions of Bitcoin all the time, telling everybody about that. Okay, and these other questions about Lux M2 has gone up about 9% in the last 12 months. I didn't calculate that. In general, it looks like, when I fit it the 10 years, the power was 9. And if you went, I just calculate this on the spot. If it is 9% with a power of 9, Bitcoin should have gone up by a factor of 2 in the last 12 months. And I don't think that is the case. So it's possible that right now we are going a little bit slower than the usual relationship between M2 and Bitcoin. But yeah, a small change in liquidity usually means a big change in price. Um, does that mean M2 will finally kick off between? Look, when we had a bubble, the temporary bubble during November, I already predicted ahead of time because it just happened when usually we do have bubbles in the November of it. I measure usually my way of measuring cycles from top to top. So we usually have 1 year down, when we have 2 year along the power law, and then 1 year up, right? So it's basically in November it was the third year, so it was supposed to be the beginning of a bull run, right? And then we will have 1 year of bull run. I was lamenting all the time that the price was going up and liquidity was going down. At that time, I was not using the um, this delay, because I will have a look at that and say, oh, liquidity is going down. That means price is going down. That is a predictor. That in a few months from now we are going down. And in fact, we went down. In February, we started to go down. So now we are going up again. So that is good. Now it's just one more sign. There are many signs that say the cycle is not over. We had some anomalies during February, until April. We are back above a power law trend, and it's possible that we will continue to have a bubble like we had it before. And in fact, we even reached 200K. That is what I predicted. And Steven has done similar prediction that Steven calculated at least in 3 or 4 different ways, and you always end up to similar values to the one I calculated, because that is the truth. Like, if everything happens like before, we are going to reach kind of that value. It's not excluded yet, right? I mean, if we were in October and November, yes, because we will have 1 month and Bitcoin doesn't jump by 2 in few weeks, in particular now. But we still have 5-6 months, so it's possible, So we will see. Okay. Do you both have an opinion for when BTC top will be? Does this model have an opinion?
This approximate entropy model does not have an opinion. It showed, the existence of a mini bubble that peaked in December of last year, and it had the, precursor warning for that. And so that was consistent, but it hasn't given another signal. So you have to look to other models to get an opinion. This, I don't know if you can see it, but this is the chart from the log periodic power law model. And it says that we're kind of in a critical time. If we want to get, there's a lot of glare on the screen, but we need to get through this next little bubble if we're going to stay on that model. And that bubble
Do you
is
have an
kind of like,
update? Do you have an update of that? That will be cool.
no, I'm going to go back and I need to do an
Yeah.
update of that. And maybe for next week, I'll show it. But we need to have some bubble going on in the June, July timeframe to stay on that particular sequence. And we would want to get up to 120,000. So that would be confirmatory. We've got the liquidity backdrop. Maybe we've got the geopolitical backdrop. I think we've got the fiscal backdrop. So we will see.
Right. Yeah. So it's not quite a matter of opinion. If the way to think about this correctly is this, right? I say all the time, the power law that is the backbone of what me and Steven do when we analyze the Bitcoin behavior says one thing. We call in physics, we have all this order of approximation. There is this order that is called the zeroth order. That means the most basic thing that you can discuss about a phenomena, right? Before anything else, with zeroth order. Then you have zeroth order approximation. Then you have first order approximation, second order approximation. So the zero order, that is the power law, says which bubble are you talking about? There are no bubble, because the entire idea is that if you have the reason why you have a power law over a long period of time is that the bubbles cancel. We go up as much as we go down, and we always go back to this power law support. So they cancel out. It's almost like they didn't exist. In fact, you can take an average over 4-year period, and it looks exactly like a power law. The moving average looks like with a slight bump because of a bump. The bubbles are not completely canceled, but 4 years is the right amount because the cycle are 4 years long. They basically look like it approximates the power law. In fact, it looks like a little snake that is oscillating around the power law. It's really interesting. But this first order approximation, when you say, okay, well, after all, these bubbles exist, And so then you can start to study them. And the best way to study them is actually to use the power law, because the power law is a reference. Stephen has done many studies where he revisit other techniques that people use to study Bitcoin. But the problem with these techniques that they never use the power law as a reference. You're coming up with wrong conclusion because they don't include that trend. Or exclude. Sometimes you can simply say, okay, let's exclude it first because that is the basic behavior, and then you see what is left over. And this is how you study the bubble using the power law. It's not the power law per se doesn't say anything about the bubbles, but you can study better the bubbles by taking out first the long-term trajectory, and then say everything else that is left over are the bubbles, and then now you study them in a more relevant way. And then you see many patterns. You see periodicities in these bubbles. You see a decay of the peaks, but even that is predictable and follows a mathematical pattern. And you can do it in many different ways. And then the idea is, if this is what I say all the time, if the patterns persist and it is going to be repeated this cycle, that is a big if, then this is what to expect. And it's not a guarantee. At the same time, one of the reasons why we do models is because even when models do not work, you can compare what it should have happened with what is happening. So it's a way of actually knowing that something is different. If you didn't have a model, you will not be able to do that. So this is the different way that you understand